agencies who themselves have to retool, and there's a need for a greater amount of due diligence. The big question that all of us have to face is, what does that mean for globalization? What does that mean for financial integration? There are those who believe that this is the beginning of the end for globalization and financial integration. That there's been so much abuse that the politicians, and I'm going to come back to the political angle in all this, which is important, the politicians will say enough is enough, as that is so powerful that it will continue for a long time. We are in the middle. This is not the end of globalization. It is not the end of financial integration. The dynamics there are way too powerful to be stopped. But this is the time when people are going to step back and rethink a lot of things, including their operating models. Why am I saying this? Because the politicians have got interested. Why are the politicians interested? Because they've come to three distinct realizations. First, they've recognized that all these falling financial dominoes end up on Main Street, and Main Street votes. And you have a presidential election coming up in the United States, and therefore this is a political issue. And that is why you got the fiscal response that you got so quickly. And that is why there is hearing after hearing in Congress going on. The second reason why the politicians have focused is because the banking system has been disrupted. And banks enjoyed a tremendous privileged position in Western economies because they have access to the central bank windows. Not only that, but rating agencies who have a monopoly given to them by regulators have also been caught sleeping at the wheel. And anybody who saw last night the debate in the UK Parliament on the nationalization of Northern Rock will know how political the banking system has become. So the politicians are very interested right now in the financial system. And why is it that institutions that we took for granted or gave privilege got caught out? The third element has to do with the reality of the world we live in. History gives you certain entitlements. People get used to entitlements, and people resist any erosion in entitlements. But one of the reasons why all this is happening is underlying this is a very healthy rebalancing of the global economy. With the US having run a current account deficit of 6 to 7% of GDP for a number of years, with the rest of the world and emerging markets in particular having become more responsible in the way they run their finances, there has been a massive shift of wealth from the developed to the developing countries. And the developing countries now are the buyers of assets, and the industrial countries are the sellers of assets. The poor is buying from the rich. That is very disturbing to politicians in the industrial world. They see their assets being sold to other countries. That is a natural consequence of the realignment of economic power. It is something that will continue. It is something that is healthy because it is consistent with the recycling of the global imbalances. But it will take time for politicians to understand that this is the case. The reason why I'm saying that is that looking forward, we can have a policy mistake that will complicate things. We can have protectionism not only on trade, but also protectionism on capital flows. So where does all this leave us? The disruption that started in an obscure and arcane part of the financial system has developed into something much larger. And the reason why it has developed into something much larger is because the financial system of the world took advantage of financial innovation to do things that it could not sustain. The infrastructure at the firm level, at the national level, and at the multilateral level could not sustain all these new activities that have been made possible by financial innovation. In this process, until the circuit breakers get ahead of the falling dominoes, there is a risk of both a market accident and a risk of a policy mistake. And the risk of the policy mistake is accentuated by the political dimensions of what's going on. So what are long-term investors to do? How should they react? From my experience at Harvard, I can tell you that the answer to the dilemma of long-term investors boils down to getting four things right. First is to understand why your capital gives you an edge. In the financial system, you never want to be part of the game, as they say, unless you know what your edge is. Because if you don't know what your edge is, then other people are taking advantage of you. And the edge for long-term investors, especially in this region, is the nature of their capital. They have something that other people want desperately right now, which is balance sheet strength. It's not just the amount of capital you have, it's the stability of that capital and how you're thinking about the return. That speaks to the first critical element of the success of any long-term investors, which is to translate their capital attributes into what is their edge, and therefore what is their return objective and what is their risk tolerance. And this world today speaks in a very powerful way to anybody that has what I call privileged capital, long-term capital that is not subject to short-term redemption. This is the world for which this capital is made. Because you can step up to opportunities that were unthinkable just a year ago or 2 years ago. The second element is to translate that into an asset allocation that speaks to the mission of the capital. And from my discussion and from our assessment of what's going on, you should take two things away from this. One is that the more international, the better, including in parts of the world that are now gaining momentum and that are the next breakout phase in global growth. And the second, don't forget what all this liquidity that's being injected is going to do going forward. We will see the return of inflation in a year, in 2 years' time. There is so much liquidity being pumped in, there's a lag structure. And if you look at how the commodity markets are reacting, If you look at how the yield curve in the United States is steepening, it is telling you that we are going to have to start worrying about global inflation in the next year, 2 years, 3 years. So make sure that your asset allocation not only takes into account the realignment of the global economy, but also make sure that you have protection against the return of inflationary pressure. The third element of any successful long-term investor is not just to have the return objective and risk specified, not just to know what asset allocation, but to find the right vehicles. And we learned a critical lesson at Harvard Management. Don't believe what your investment managers tell you. Analyze what they do. So many people got caught doing things that they shouldn't have been doing because it seemed so easy. It seems so easy to leverage. It seems so easy to play the carry trade and invest in all sorts of credit products. It seems so easy to buy structured products that were AAA, even though they were saying something different about that. So the third lesson for long-term investors is be careful about your investment vehicles. It doesn't mean you shouldn't think of leverage. It doesn't mean you shouldn't think of going long short. Just make sure that whoever's doing it for you is anchored by some deep, deep roots in terms of investment management. Let me end here, and I'm happy and delighted to answer any questions you may have on any topic you may have. Thank you very much.
Please direct your questions now to Dr. Al-Erian. We have a microphone for your use.
It's dependent on the rating agencies' output. And if these are themselves suspected based on the track record, what should be done to reform these?
And that question is being debated in Washington right now very actively, which is that one of the assumptions of the global financial system is that the rating agencies know what they're doing. Because the rating agencies act as the gatekeepers. Although they don't like to admit it, they act as the gatekeepers to many, many investors. And what we've discovered, and not just for the rating agencies, we discovered the same thing for the bond insurers, the monoliners, is that they've gotten into things that they don't fully comprehend, and therefore their methodologies were lacking. The additional element of the rating agencies is that a few of them have a regulatory oligopoly, that they're designed as nationally recognized rating agencies. So rating agencies will come under tremendous scrutiny going forward. The answer they have, which is not an unreasonable answer, is, look, we give lots of disclaimers, right? And the investor should have known that we're just part of a process. And we never said that our methodology was 100% robust. The reality is that people acted on their methodologies. So I suspect that you're going to see over the next couple of years some reforms. I expect there's going to be a revisit on what rating agencies can and cannot do. There will also be a revisit as to the competition within rating agencies, whether you should expand the set of rating agencies so that the market itself can rate the rating agencies in terms of what they do. But what I can reassure you is we're not going to see business as usual, neither for the rating agencies, nor for the bond insurers, nor for any other segment of the financial industry that migrated well beyond its core competence.
I'm talking about the rules of the rating agencies. As you rightly observe, it appears that they've been caught napping. And possibly because they do their